Good news on the inflation front. CPI came out this morning and there was a small decline. This was in line with a lot of what analysts were expecting. The stock market rallied. Is this a sure thing that we should all be buying into this market? Let's break down some of the things that I'm looking for as to what I think might happen next and the reasons why. Let's jump in. First time joining me, thanks so much. This is a new channel that I've broken out from my original channel where I break down the basics of what's going on with the stock market. I look at SPY, ETF, the SPY stock, and all the other little various aspects. If you're just stopping by, please, by all means, hit that like and follow button. The channel is growing quite rapidly. I'm really happy about that. For those of you who have been stopping by, my apologies, but I had a medical emergency last Thursday, and it is now Tuesday, and I'm finally feeling somewhat like a human being, so I'm getting back into it. Hopefully, I can continue to get content out on a regular basis. Here we are looking at... this is actually the S&P 500 itself. The SPX index shot up, I think it was about nearly 2% for the day. NASDAQ, I think, climbed about 2.15%. The Dow was only about 1.5%. The move was pretty strong. I think it was a little overdone. Here's a bigger look on the time frame. This goes back a couple months. So we've basically retraced everything that we lost since the beginning of September. Now, the 10-year Treasury bond really started going haywire in September. No one really knows exactly what was going on then. And anybody who says, oh, it was because of too much supply, which even I bought into at one point, that seemed to have been wiped away just last week because we had an auction, the Treasury had an auction for brand new notes on the 10-year, and there was quite a bid tone for it. The 10-year yield dropped, which means price went up. If price goes up, that means people are bidding up a lot for the 10-year. So too much supply may not have actually been the mechanism that pushed the 10-year down. What I actually think is someone was taking it pretty hard and they decided to get out of their bonds and they sold off those bonds and interest rates went higher. Because of that, the stock market sold off sharply. But where do we go from here? The first question you ask is, how well is the economy doing? Not that great, actually. Take a look. We're going to be starting to get retailers. Retailers are going to tell us how well the consumer is doing right now. The consumer who has record high debt and is starting to default on all that debt. That doesn't sound like an economy that's going to expand rapidly. It's not. Interest rates are going to remain high for a long time, and there are mechanisms that are going to drive that have nothing to do with the inflation number we got this morning. First off, we have the M2 money supply. This is something that I don't think a lot of people pay much attention to because it doesn't make that much of a factor until it does. Right now it is. The money supply is too much. There's too much liquidity out there. So what the Federal Reserve needs to do is shrink the money supply. They are part of the problem. They're mostly the problem, actually. Here's the Federal Reserve balance sheet. And as you can see, they kind of pushed everything upward in a significant way. Of course, 2020, they were trying to taper things off previous after all the things they did in 2008 and thereafter, QE1, 0, 1, 2, 3, you lose track of how many times it did quantitative easing. All that liquidity is the potential for a bank to loan to a customer. What they're doing is raising interest rates, which makes it more costly for anybody looking to borrow money because less individuals, that rationing mechanism will be borrowing more money. You'll get more individuals withdrawing money and therefore shrinking the money supply. Along with that, the Federal Reserve is not going to be continuing with their bond purchasing programs. So anybody who may have money in the bank would be taking over where the Federal Reserve is not. They're going to be buying U.S. Treasury debt. So you're going to see money being taken out of banks. buying into debt. That is not going to expand the economy if the money supply is shrinking more and more. Finally, there's one more thing, of course, the U.S. deficit. The U.S. deficit continues to grow at a pretty fast clip. There's a multitude of reasons. Yeah, both presidents are to blame. Actually, neither president is to blame. It's usually the Federal Reserve. It's almost always 97.5% of the time the Federal Reserve. It's their game, and they're really destroying it. The deficit itself, again, does not seem to be that big of a deal right now, simply because we just had that auction last week. 10 years were bid pretty well, pushed the price up, which means there was a lot of interest. Yield fell. That was good news. But where do we go forward with the S&P 500? Consider the consumer, who is not in a really great place right now. They are 70% of our economy. The consumer is contracting. Record high debt. Defaulting on record high debt. That is not an economy where every single business is going to be sitting there saying, revenues are just going to be ramping up higher and higher and higher. So will profits. Therefore, our stock prices should be doing exactly the same thing. So when I see these kind of moves, I see it as kind of like a fake move, because ultimately this is a higher springboard to go downward from. The economy is not moving forward. These companies who make up the S&P 500 are not going to be seeing increasingly higher revenues and profits. They're already overvalued when you look at them from the perspective of, say, an investment in something that's a lot more secure, like the 2-year. The 2-year is a dream investment right now. You can get in at about 4.5%. Your downside is nearly zero. Your upside, 15 to 20% in the next 2 years. Why would you buy stocks when you're looking at the S&P or the 2-year note, sitting there saying, listen, there's almost no downside. I'm guaranteed at least 4.5% over the course of the next 2 years. And more than likely, there's some upside if the Federal Reserve within the next 2 years has to lower interest rates, which they probably will have to lower interest rates eventually within 2 years. Then you start comparing an investment in a stock. Take a look at the next 4 quarters. Divide that, add those up, those 4 quarters for any particular stock, divide that over the current price. You're seeing yields at 3.5%, 3.25%. There's an economy that's contracting, and you're only going to get maybe a yield of about 3.25%, or you could buy the 2-year Treasury note, which you get 4.5%. Savvy money will be jumping on that 4.5% all day long. So this move higher in the S&P 500, SPY stock SPX index, I think it's a fake. Sure, might go higher. But for me, this is just a springboard to be buying puts all day long. Because eventually, the news is going to start hitting that, hey, listen, we have to downgrade our revenues because the economy's tightening up too much. And that's the rally we saw today gets eaten up. Plain and simple. I'm going to keep posting this information out there for you. Make sure you hit that like and follow button. Again, apologies for the medical emergency. I hope to be in much better shape over the next couple of days, and I'll be able to continuously get these videos out to you. Thanks so much. See you in the next video.